Hello and welcome to Portfolio Matters Weekly Update Week 17. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. We are recording this on Thursday night due to scheduling difficulties. This week's events, well, the FOMC meeting was uneventful. Basically, Powell was emollient and essentially continued with no change in rates and no change in the bond buying program, despite rising indications of inflation, which he believes will be transient. We are skeptical. US Q1 GDP data came out, and that was beat expectations. Annualized growth of 6.4% compared to expectations of 6.1%. And Biden is brewing a big tax increase to pay for all his infrastructure and other spending. So,
yes, and also I think inevitably other countries will also be starting to consider large tax increases, and I think the global agreement on corporation tax, which is being mooted, is a sign of governments increasing their tax take and not wanting to have any way to sneak out of it. And I think we all need to brace ourselves for significantly increased taxes over the next few years.
Absolutely. What always amazes me, Richard, is how changes in corporate taxes seem to have much less effect on share prices than a rational calculation would indicate they should. So, but anyway, watch this space.
Yeah. So just pick this from the Financial Times. The EU has warned about an insolvency tsunami coming in small businesses when the support is removed and the economies begin to open up. And that clearly would be very bad news for the EU economy and probably could be replicated everywhere else.
Absolutely. There are a lot of zombie companies being maintained by very low interest rates and state support, cheap loans, etc. during this period. And we're just going to have to wait and see what happens when those support end.
I noticed that Lloyds Bank, one of the reasons it had good results was because it released a chunk of its loan loss reserve. And one wonders whether it's done it a bit too soon. Time will tell.
Yeah. Okay, now I saw this chart, which looks absolutely frightening. This is the annual change in margin debt in the US. And the clear implication of this chart is that there's been an enormous increase in borrowing to support speculation in the stock market. And when that ends, that could potentially be very bad for stock markets. However, I then saw this chart, which correlates margin debt with the Wilshire 500 index. And you can see there's a very high correlation between the two, which means that actually margin debt may just be a function of the level of the stock market rather than the other way round.
A consistent ratio, basically, as a proportion of the value of the stock market.
And that is much less worrying.
Yeah.
So, but there clearly is a correlation between falls in market margin debt and the market itself. And with margin debt having risen this strongly, then it has to turn down at some stage, and that could well be very bad for the market.
Yeah.
And according to FINRA, which is the Financial Integrity Regulatory Authority in the US, margin debt has already started to turn down in the US. So, not a good sign. The markets have had an absolutely extraordinary period. And I really am beginning to wonder whether we aren't overdue a pullback.
Yep.
And moving on to one of our favorite topics, inflation. And what this shows is that inflation comes through about 18 months after the PMIs. And what that means is PMIs are shooting up, and in 18 months' time, you would expect inflation to follow. Yeah. And based on historic relationship, you're talking about inflation in the US of between 2.75 and 3% next year. Talking about inflation, the Baltic Dry Index, which is an index of how much oceanic transport costs, how much it costs to move a container around the world, has absolutely shot up. You see, in 2020, at the bottom of the COVID panic, the index was at 500. It's now above 2,500, so a five-fold increase.
The next chart is an interesting one, Keith. This is a historical chart of the Baltic Dry Index going back 40 years. And in fact, it sort of seems to hover around about the 1800 level. And it's moving up from that point. But historically, it has yet to reach the highs of the mid to late 2000s. One of the things I read actually recently was that apparently a lot of cargo ships have been taken out of commission because they burn environmentally unfriendly fuel, bunker fuel. And so a chunk of cargo fleet has actually been removed recently because it is now illegal under international maritime rules for them to be used. And that's created a shortage of suitably powered vessels as well. And then we had the problem with the Suez Canal, and we seem to have problems with offloading of containers at ports being much slower, presumably because of COVID, than it has been, resulting in a huge shortage of shipping. Now, things will amend themselves to correct that in due course, including the production of new ships, but that will take some time to come through through the system.
Yes, you've just reminded me, Richard, actually, that new sulphur emission standards came in, and the cost of putting in sulphur scrubbers was quite high, and they scrapped a load of vessels. But also, I would say that that's on the supply side. On the demand side, international trade is going through the roof as everyone spends on manufactured goods because they're not allowed to go out and spend on services. So actually, I see this rising further.
Yeah, I think it will rise further, won't it?
And
I would agree with that, Keith.
Because the thing is, we are on the chart we saw previously, we are kind of looking at just this period here, and when actually the Baltic Dry Index hit pretty much an all-time low. So we're comparing it to its all-time low. When you look at it compared to its long-term average, it's not actually that elevated.
Not yet.
Okay, bond yields. The mystery in last month has been how bond yields have remained quiescent when they're seen everywhere we look. There are indications that inflation is coming. And this is another chart which shows the gap between PMIs and bond yields. So there's historic correlation between the two, but now PMIs have gone through the roof and bond yields have failed to follow. So if this relationship were to hold, you would expect bond yields to shoot up over the next year. And talking about the outlook for inflation, what this chart shows is the dark blue line is job openings in the US. And you can see there are a lot of, and that's the right-hand chart here, the change in job openings has increased a lot in recent months, and unemployment tends to follow that with a lag. So you're expecting to see unemployment come right down over the next 6 months. And this shows that there is a contradiction in the US in that companies reporting that job openings are hard to fill is the dark blue line. And you can see that that is about 45%. But but the number planning to increase compensation has not changed. So they're all saying, well, we're finding it hard to recruit people, but we're not going to raise wages. And, if they want to square that circle.
That would be because they don't want to raise prices, because they'll be concerned about losing sales, Keith, I expect. So at some point, they will obviously have to raise prices in order to pay people more. But I guess this process doesn't happen overnight. It takes quite a long time for the system to slowly wind itself up.
Yeah.
Obviously, the fear here is that it is going to start winding itself up.
Absolutely. I mean, we talked last week about how low-paid workers were finding it more lucrative to stay on unemployment benefits than to go back to work. And essentially, what this is saying is that employers have not yet got the message they need to raise prices, raise wages. But
raise wages,
they will.
Yeah, so this is the cumulative confirmed COVID-19 cases. And you can see, I like this chart. This is the actual numbers. So the UK down there at 4.5 million or so. You can see that India is actually on an exponential curve upwards, and Asia, which obviously India is part of, is also on an exponential curve up. But the United States and Europe are leveling off. UK leveled off probably about 6 or 8 weeks ago on this chart. But what we have is this surface stats where around the world there are nations which simply don't have COVID under control. And they are highly populous nations. And the more individual infections there are, the greater the chance of having variants that are immune to already existing resistance to other variants, or which can bypass to some extent the vaccinations that we currently have. So this is dangerous for the world, and not just dangerous for the countries where it's rising rapidly.
Absolutely. I think I have certainly underestimated how long COVID disruption would last. And it could well be, we're now all thinking things are going to open up again. But based on our experience of the last 18 months, that could all be premature.
Yeah. I don't think it's a done deal yet. But however, this graph shows that the UK is rapidly reopening, Keith, which is very positive, and we're very pleased.
Absolutely. This chart shows the Goldman Sachs US Financial Conditions Index. Now, I'm not sure what goes into it, frankly, but it purports to show that US financial conditions have never been easier. So, which is very good for investors and for the economy, though not necessarily for inflation. And this chart shows the difference between expected earnings in the US and in Europe. And you can see in the US, well, over the last 10 years, the US has massively outperformed Europe, but also that US earnings are now back above pre-COVID levels, whereas European ones are well below, which is perhaps not unexpected given the relatively poor performance of Europe in tackling COVID. But there is now
I also think, Keith, that the US has something like 9 out of 10 of the largest tech companies.
Yes.
And tech companies are massively profitable and have increased their earnings substantially during the COVID crisis. And Europe really doesn't feature it has something like 2 out of the top 20 tech companies in the world, and the US has most of them. China have a few. So it's probably also a reflection of that skew in the ability of the US to generate earnings from tech companies.
Well, also, if you look at the whole period from like 2010 to 2017, European earnings basically went nowhere.
Yeah.
And so, growth, as Richard has said, has been in tech companies in the US. Interesting. Okay, now on to the weekly checklist. So the all share had an okay week, up 0.4%. S&P up 0.6, NASDAQ up 0.7, Topics, the Japanese index, down 0.3%. Bitcoin had a good week, recovering from last week's fall, up 8.9%. And GBP, sterling, rose 0.7%. Now, I wanted to talk about this chart, which shows Tobin's Q ratio. You remember that Tobin's Q ratio is the ratio of market cap over book value. It's the replacement value. So the idea is if the Tobin's Q ratio is above 1, then you can simply set up a different company because it's cheaper to go and buy the capital goods to set up a new company than it is to buy the company on the stock market. And so what this chart purports to show is that companies are massively overvalued relative to their assets. However, I personally think Tobin's Q ratio is of very little relevance these days.
It doesn't take into account goodwill, does it, Keith?
Absolutely.
And goodwill is a massive part of the business of many modern companies, technology companies particularly.
Yeah.
So and service companies.
So it assumes that a company is a function of its capital stock. And for companies which are increasingly a function of software and human intellect, neither of which create many like physical assets and book value, I just don't think this is very relevant anymore, frankly.
Well, I would agree with you. We're moving into more and more of a service-led economy, where the goodwill that is earned through investment isn't put into this calculation.
Absolutely.
But it is a valuable asset for creating earnings. Okay.
Now, what this chart shows is the white line is expected earnings. The blue line is the S&P 500. And you can see that since February last year, essentially earnings in the US have now recovered to their previous levels pre-COVID. But the S&P 500 is up best part of 30% relative to earnings. And so what you can say is the expansion, the performance of the S&P 500 has been due to multiple expansion more than earnings. And how long can that continue?
As long as interest rates stay low and continue falling, Keith.
Well, exactly. And we both know what we think about interest rates, Richard. And now I am becoming increasingly concerned that this particular leg of the bull market is getting a bit long in the tooth. It's 6 months since the last 5% correction, and we're heading into May. And regular viewers will know from the seasonality chart that after May, there is a bit of a pause in equity markets. And I am increasingly thinking that a lot of financial markets, including commodity markets, just look a bit overstretched. And this is the amount of options buying in the US. And you remember that the Reddit crowd, Wall Street Bets, were responsible early in the year for buying huge volumes of options and squeezing GameStop and other small dodgy companies higher. And they managed to make a great deal of money out, actually.
The thing is here, Keith, that the options market makers have learned what's going on, and they're just pricing the options accordingly so they don't lose money.
Absolutely.
And so now you buy an option, it's much more expensive, and and if the market isn't soaring on any particular stock, it expires worthless.
Absolutely. And the other thing I'd say, Richard, is people are going back to work now. I wonder actually in the end, as you say, how many of them made money? They might have made money out of the first squeezing GameStop, but every time they tried it later, the market makers got wise. And I suspect a lot of them have lost money and now they've got to go back to work. So I think it's going to drift back down again.
Yeah, I agree, Keith.
Okay, moving on to industrial commodities. And, the general picture is of continued strength. Aluminium up 0.8%. Cobalt came off, and we will look at that. Copper, again, another amazing week, up 4% on the week to a new high. Iron ore just absolutely defies gravity, up 3.5% on the week to $192 a ton. Lithium was flat. Neodymium came off hard, down 9% on the week. Nickel recovered from its lows. Ferrovanadium flat. WTI had a great week, up 4.2%, and the latest inventory figures from the US show that US inventories fell by about 3 million barrels on the week. So inventories have continued to fall, and that is good news for oil. Uranium was flat.
On the subject of uranium, Keith, otherwise we'll forget it, I noticed that Japan is now starting its old nuclear reactors again, and it requires to run its nuclear reactors to produce 20% of its electricity demand. Otherwise, it won't meet its carbon dioxide targets. Right. So Japan will be restarting its reactor fleet.
Okay. Well,
increasing demand for uranium.
I look forward to the start of the bull market in uranium, Richard. It has certainly been well flagged. Now, one of the things we talked about last week was the term structure of the oil futures curve. Now, and if you remember last week, I was saying that the futures market was not as optimistic about the oil price as equities were. And you can see here why. So see here the details. So this is the spot crude price, and this is the price going forward. And you can see, actually, there's a huge drop. So they're saying that in 2026-27, they're expecting the crude oil price to be $51. So that is in part explains the relatively poor performance of oil stocks. But
although I would say, Keith, if I could accurately foretell the future 6 years in advance, I'd be a great deal more wealthy than I am today.
Yeah, well, I would say I think they've got this absolutely entirely wrong. And I have been reading the JP Morgan oil super cycle report from last year this week. And before the COVID-19 happened, they were forecasting an oil supply crunch starting between 2022 and 2024. And that was before CapEx budgets got absolutely decimated last year. So that is going to increase the medium-term supply crunch. And frankly, I think that supply crunch is now baked in and unavoidable. And it will take a few years before it really starts to bite. But once it starts to bite, you have no options. These big, deep offshore wells take years to find and drill. And I think you're going to see an oil price spike in a couple of years' time.
Very interesting. Commodity momentum chart. Percentage of commodities up 50% or more. And you can see that where we are now is the highest since 1972. And just another indicator of the impending burst of inflation that we're going to see.
Yes. Well, we all know what happened to inflation in the 70s, Richard.
We do, don't we, Keith? It finally fell after interest rates were increased to 15 to 20%, depending which country you were living in.
Yes, yeah. That was bad for investors. Yeah. Okay, now I have become, as you know, Rich and I both really like copper. And copper is absolutely essential to the clean tech transition. But I just think the copper price is rising in this linear fashion that I just don't think is sustainable. And I think that it's got a bit of ahead of itself, particularly in the last month. If you look at the last month, I mean, it's really shooting up and it's due a bit of a pullback. So if you look at what happened after the financial crisis, when there was a strong recovery in copper, you see you had the copper price shoot up, but then there were several strong declines before in the bull market. And I really think we're overdue one. I think we're overdue a decline in copper. And so I am bullish copper, and I have a couple of copper stocks that I am researching and I would like to buy, but I'm going to resist because we're also approaching May. And you'll see here that there's a big starve starting in May. So I'm going to resist the temptation to dive in.
Okay.
Lumber prices are just getting silly. Frankly, this is complete. I just think this is unsustainable. There's been a lot of disruption to the lumber supply chain, but that is a huge incentive to sort it out.
Exactly, and I'm sure there's a speculative input here, Keith, isn't there? That the sort of final little bit of the line from sort of February to now, it has to be some sort of speculative inrush that's pushing these prices up at this point.
When these things get ahead of themselves, when the bubble bursts, it bursts very, very fast.
Very painful if you're in it.
Copper, amazing chart. Iron ore, amazing chart. Crude oil. Now, crude oil, having had this period since essentially mid-January of decline and oil stocks have had poor performance, is now creeping back up. And importantly, inventory drawdowns have resumed in the States. So I personally can't see oil really recovering to above $70 because OPEC are completely in command of this market. They have at least $6 million in reserve, and it will suit nobody if the oil price goes too high and starts to suck demand out of the world economy. And you remember that if the oil price goes too high, it tends to induce recessions.
Yes.
So I think if the oil price starts to approach $70 a barrel, they will release more to reduce it again. Cobalt, and frankly, this is the sort of pattern I'm expecting to see copper make. When it shoots up, it just gets too high on speculation, and then there's a natural pullback. Nickel, and this is exactly what you see in nickel. See, it got too high, sharp pullback, and this week it's resumed its climb. And I'm expecting to see that in copper and iron. Well, in iron, frankly, I'm surprised it's got this high. And in neodymium, you can see that process in action. So neodymium had a bad week. It's down 9% from recent highs. Okay, moving on to precious metals. Well, today, bond prices rose, and that caused a sell-off in precious metals. And gold is down 1% on the week. Silver is down 0.7%. Platinum down 1.4%. Rhodium is flat, down 0.3%. Palladium had a good week as people continue to switch out of rhodium into palladium for catalysts. Regular viewers will be aware that we have a regular slot of dodgy gold charts. Well, actually, I found some good gold charts. And so we've got 4 charts which purport to show what the relationship is between gold and fundamental drivers. And this first chart shows that there's actually surprisingly little relationship between the physical demand and supply and demand for gold in the market and the gold price. So on the x-axis is whether the gold market is in surplus or deficit, and the y-axis is the gold price. And you can see there's no relationship, frankly. And right now, the gold price is very high. And actually, well, this chart is old now. It's come down from that. It's now $1,770 rather than $1,900. But the gold market is in surplus, but the gold price is high. Next chart shows the relationship between the gold price and the US dollar. And there is a relationship, actually, but it's not very strong. It explains about 20% of the movements in the gold price. So weaker dollar, stronger gold. Now, the things that do explain changes in the gold price are inflows and outflows from ETFs. And you can see stronger inflows, purchases of gold by ETFs mean a stronger gold price.
We don't know the cause and effect on that one, do we, Keith? it could be that the gold price goes up, people buy into the ETF.
Yeah, that is true.
So that falls into the category of a dodgy chart.
Well, yeah, there's clearly a feedback loop there, but you would expect, demand, higher demand should raise the price, so it's logically correct. And finally, there is a relationship between gold and inflation protected bonds, TIPS, and that is a strong relationship, 70%. So an increase in the price of TIPS means a higher gold price. So what that means is you should be watching inflation protection of the TIPS market to see where gold goes. Okay, on to the charts. Palladium, this is an amazing chart, looks great. Rhodium, had a bad week, but the bull market remains intact. You will remember that Goldman Sachs are forecasting $100,000 an ounce. Bitcoin, Richard.
Yeah, so Bitcoin got really knocked, didn't it? And I think it's down 25-30%. And it's resumed it's regained a little bit of its poise, but hasn't actually gone anywhere now since really sort of mid-February.
Yeah.
And so you can say that its meteoric climb up until that point has definitely stalled. Where the price of it goes now, don't know. If we move on to Ethereum, so Ethereum moved down with Bitcoin, but not so much, and it has regained a new all-time high.
Wow!
And I think I noticed yesterday, I read that I think the ECB is launching a 200 million euro bond using Ethereum to manage the documentation.
Really?
And I think what may be happening is that people are starting to see that there is possibly more of a real world use for Ethereum than there is for Bitcoin, and which has always been my thesis. And that is therefore increasing demand for Ethereum because people are imagining it's going to have a real world demand as opposed to this sort of putative store of value that people say Bitcoin is.
No, I didn't know that. Interesting.
Oh yeah, so obviously the shit per crypto chart plummeted as we saw last week, but interestingly, with the recovery of the poise to an extent of Bitcoin and the super recovery of Ethereum, it's not done badly at all over the last week. And so if you're a holder of various of these coins, then last week would have been a good week for you.
Interesting.
Basically, these coins, they must follow Bitcoin and Ethereum, I think.
Well, I'm just naively looking at this chart. I'd say that the shit perp market is at a crucial point. Having had this reflexive bounce, is it going to resume its fall, or is it over?
Or is it going to make a double top and then fall, or is it going to carry on? Who knows?
Exactly.
But I do think the point is, if you actually want to invest in these things, you have to pick ones that have a real world, have a viable real world use, or realistic real world use.
Yeah. Okay, so on to yields, and after a month in which yields largely actually fell against all of my personal expectations, last week yields resumed their rise and actually rose quite strongly on the week. So you'll see the UK 5-year rose by about 8 basis points on the week, the 10-year by almost 10 basis points, the 20-year 8 basis points, and the 30-year by 7 basis points. And if we move on to the charts, you'll see that US 10-year inflation break-evens are continuing to rise and now approaching 2.5%. The UK 30-year, having declined actually steadily since the 1st of March, has now begun to rise again. And actually during the week, it was up every day. And in the US, you see the same pattern. So, having had this pause, will yields now resume their rise? Richard?
However, this is the 3-month Treasury bill. Recent pricing is it actually has achieved a new low of 0%, or equivalent low of 0%. So the 3-month Treasury bill yield has dropped back down to 0%, minus 0.0017%. And that is contrary to what Keith has just been talking about. And I think one of the conclusions you can draw is it's really unclear what is going to happen with interest rates. And the potential for yield curve control is probably muddying the waters as well.
No, I would like an explanation of this. At first glance, I'm mystified because the Fed's target funds rate is 7 basis points. So why has this gone negative?
Well, it's an auction, I guess, and it's demand for the auction by people who want the collateral.
Yeah, but it mystifies me. Anyone would pay money for a 3-month T-bill when you can,
well, presumably they can do something with it that is more valuable to them than a slight negative yield.
Exactly. Practically anything,
Yeah.
Copper's going up every day, whatever,
Yes.
And back to our favorite chart. So last week we were forecasting that markets would do nothing at all, and we were pretty much bang on. Markets were flat. Next week is going to be a great week.
It's going to be a good week.
It's going to be a good week. So stay long. Right. On that note, Richard, what's your activity been this week?
Thank you, Keith. So a quiet week for me this week, Keith. I was up 0.7%, 10.2% year to date. The only purchase I made was Mobility One, which, if those of you who watched Luke's share tips the other week, Mobility One was one of the shares he commented on. And I was quite taken by it. This is its graph. So it has a market cap of £20 million, enterprise value of 18 million. It is in the business, as a recap, of providing e-commerce infrastructure, payment solutions and platforms, electronic transactions and payments in Malaysia, although it's quoted in London. And I think it has tremendous growth potential, which is why I bought it. It's done well this week, which was lucky.
Very good.
That's me, Keith. How about you?
So I had a good week. I was up 2.1% as oil finally moved back up, and also oil stocks followed it, which compared to recent history is a good thing, because oil has been moving up and oil stocks have been going down, which has been frustrating.
Well done, Keith.
That takes me to 6%, plus 6% on the year, which is a lot lower than Richard. And also I'm underperforming the all share, which continues to be disappointing. So I did a few sales this week. I decided to take some money off the table so that I had cash, because I am expecting a pullback in equity markets. And I have a few stocks, particularly copper stocks, that I am interested in, but whose share price has done a bit too well currently. And I want to have cash to buy them over the summer. So I sold my silver, which had done poorly, and I sold my platinum, which had done well. Thankfully, I had twice as much platinum as I had silver. So, that's all right. And finally, I sold my Petrofac. We talked about Petrofac last week. The annual results came out, and I was hoping that they would have done a deal with the SFO. They didn't. And so I closed out the remnants of my position because, frankly, they don't have any markets left. They've been closed out. They're not allowed to bid in Saudi Arabia, in Iraq, or in the UAE. Where's left?
Yeah.
And one of the great things about doing this podcast is that people send me tips. And so James Battle told me to go and look at James Fisher and Sons, which does subsea engineering and cabling, just exploration stuff for the oil industry and offshore wind. And I had a quick look, and I aim to do a share talk on it in the future, but I really like it. Basically, it is at half the price it was prior to COVID-19, and it's in the right industry for me. So I have bought a small position and will aim to add to it once I have done more research. I topped up on Rambler, and we will get into that in a sec. And Luke talked to me about Enquest, which is a heavily indebted UK oil company, and one that I'd kind of pushed the back of my mind because it is so heavily indebted. But then had a quick look at it. They have cut the debt. They're still very highly geared, but the oil price is moving, and that means maybe they'll survive. So I bought a small speculative position. Now,
well done.
We have a Discord channel, which I hope everyone will join. And you'll be aware that Rambler this week updated on 2020. And in their outlook for the year, there was not good news in that in their previous update in January, they had been guiding that they would get back to having the Ming mine processing back to its capacity of 1,350 tons a day by the end of Q3. So it would be processing 1,350 tons per day during the whole of Q4. Now they're guiding to between September and December. So at some stage in Q4, and that is clearly slippage. However, they have not changed production guidance, but I would be concerned that they would have to downgrade guidance at some stage. Now, somebody asked me what I thought they thought my price target should be for Rambler. And I don't like giving out price targets. I don't know. But what we can do is work out what we think a reasonable expectation for the share price of Rambler would be, given copper prices of $4 a pound, and bear in mind it's currently 4.45, and if they were to meet their targets for production in 2022 and 2025. So I've done a rough calculation and assigned them a P ratio of 6. And I think a good medium-term targets are, if they can get the ore sorter going in 2022, then the shares on a P ratio of 6 could be 2p. And once they have relocated the Duck Pond mill equipment to the Ming mine and are processing the ore on site at an increased rate, then the shares could reach 3.3p. And those are obviously big multiples of the current share price of 0.6p. So there's still a lot of upside in this company. And I topped up. I bought some more.
Good.
And
well done.
This is the share price since start of the year, the recent restructuring, and that's a good looking chart, although you would have to be concerned it's got a bit ahead of itself. And we are awaiting Q1 update. So that's either going to be good or it's going to be bad. And this is the share price of James Fisher. And you can see that prior to COVID, share price was what? £2, £20, £21, and it's now £10. And I can't see any reason why it shouldn't recover to where it was. So I bought some.
Well done.
And that is the extent of my analysis, by the way.
Great. Well,
So,
thank you very much for your update, Keith. Very interesting.
Great. Well, thank you all for watching. I hope you press like and subscribe to the channel and join us on our Discord channel, which we will post a link of how to get there in the description. And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.